let's review the accounting equation. The accounting equation says assets equals liabilities plus stockholders' equity. This video looks at the different types of examples of assets, liabilities, and stockholders' equity. We're still at the very beginning of the course, so I'm only going to describe some basic assets, liabilities, and stockholders' equity items. Examples of assets. Remember, I said think of assets as resources or items that a company owns. These are some of the examples we'll look at in this chapter. Cash. Cash is an asset for a company. If a company owns cash, that's an asset. Same thing with land, buildings, equipment, furniture, machinery, vehicles. These are all some items that companies own. Examples of liabilities. Remember, liabilities are debts of the company. For the purpose of this chapter, the only liability we're going to talk about is a bank loan or money borrowed from another party. Whenever a company has a bank loan or money that they borrowed from someone, we call it a note payable or notes payable. Then when we are looking at stockholders' equity, you're only going to notice two types of items. The first one is called common stock. Common stock represents the amounts stockholders invest in the company, sometimes referred to as paid-in capital. And I'll have a slide later that I explain what paid-in capital is and how common stock is the only thing that we know under paid-in capital. Common stock is actually certificates of ownership that the company issues when investors invest in the company. The other component of stockholders' equity is retained earnings. Retained earnings are generated at the company. So these are profits that are generated by the company by doing their day-to-day activities, and then it's the amount of the profits that the business keeps after paying dividends to the owners. The retained earnings at any given point in time is a running total since beginning of time. So it's a running total of all the profits and combined losses of the company since beginning of time. We'll take a look at an example in a minute. Let's go back to the accounting equation. So we know that assets equals liabilities plus stockholders' equity. We're going to split stockholders' equity into the two components that we talked about. So stockholders' equity can be split into common stock. Well, let's call it first, let's say paid-in capital. Paid-in capital represents what the investors have contributed, and under paid-in capital, for this part of the course, you only know common stock. Later on, there'll be other things that come into it, but common stock is the only component of paid-in capital. And then that is what the investors have contributed. The other part of it is retained earnings. Retained earnings are generated by activities of the company. So you could rewrite the accounting equation to expand it and say assets equal liabilities plus common stock plus retained earnings. This is called the expanded accounting equation, and we will take a look at some examples using the expanded accounting equation later. This common stock and retained earning combined is stockholders' equity. Now we're going to take a look at retained earnings in more detail. Retained earnings are affected by revenues, expenses, and dividends. So how does revenues, expenses, and dividends affect retained earnings? Every time a company earns revenue, it has the effect of increasing retained earnings. every time the company incurs expenses, it has the effect of decreasing retained earnings. And every time a company pays dividends to its owners, it has the effect of decreasing retained earnings. Let's take a look at an example where we learn how to calculate retained earnings. Pause the video, read the question, and then continue on with the video. It says, XYZ Company was formed on January 1st, 2019. In 2019, XYZ had revenues of $10,000 and expenses of $7,000. Then they told us that in 2020, XYZ had revenues of $15,000 and expenses of $9,000 and paid $2,000 in dividends. Then they told us in 2021, XYZ had revenues of $20,000 and expenses of $14,000 and paid dividends of $5,000. They want you to calculate the retained earnings on December 31st, 2019, the retained earnings on December 31st, 2020, and the amount of retained earnings on December 31st, 2021. The first thing I want to do is take a look at the timeline. So here's a timeline. Sorry, that's not really a straight line, but here's a timeline. And this company, XYZ, was formed on January 1st, 2019. Then they gave us information on what happened in 2019, and then they told us what happened in 2020 and what happened in 2021. This company was born or was formed on January 1st, 2019. So when it was formed, they didn't have any assets, liabilities, equity, so therefore they didn't have any retained earnings on January 1st, 2019 because nothing happened before that. This company did not exist. So we start off by trying to figure out what happened during the year. So we start with retained earnings on January 1st. Let me finish writing this. Retained earnings on January 1st, 2019. And we know that since the company didn't exist before that date, retained earnings on January 1st, 2019 is 0. Next, they told us that in 2019, XYZ had revenues of $10,000 and expenses of $7,000. So let's see how those affected retained earnings. Well, we know that revenues have the effect of increasing retained earnings, so that $10,000 of revenue increases retained earnings. So we're going to put that 10,000 as a positive number because we're going to add to the bounds of 0 to say that revenues has the effect of increasing retained earnings. Then they told us that there was $7,000 worth of expenses. Well, what effect does expenses have on retained earnings? We said that expenses has the effect of decreasing retained earnings. So I'm going to put that as a negative number, 7,000. So I'm going to put that 7,000 as a negative number. Now, if we had dividends, we would have included that as well, but we don't. So I'm going to leave a space for that dividends for the next year. But this will help us calculate our retained earnings at the end of the year. On December 31st of 2019, retained earnings are equal to 0 at the beginning, plus 10,000 for revenues, minus 7,000 for expenses, gives us $3,000 of retained earnings on December 31st, 2019. So the answer to the first question is 3,000. Now, in the timeline, we are here. We're on December 31st, 2019, and we determined that there was $3,000 of retained earnings at the end of 2019. Now let's look at the very next day. The very next day is the beginning of 2020. It's January 1st, 2020. If we ended December 31st, 2019 with $3,000 of retained earnings, we began the year 2020 with $3,000 of retained earnings. So when we are looking at retained earnings for 2020, on January 1st, 2020, retained earnings, we're going to say that the beginning retained earnings on January 1st, 2020 is $3,000. Now let's look at what happened during the year. They said in 2020, XYZ had revenues of $15,000 and expenses of $9,000. And then top of that, they paid $2,000 in dividends. So let's go ahead and record that. So let's say revenues of $15,000. We know revenues have the effect of increasing retained earnings. So I'm going to add that to that $3,000. We know that expenses have the effect of decreasing retained earnings. So the $9,000 of expenses in 2020, I will show as a negative number in parentheses to show that that caused retained earnings to decrease. And then they also paid $2,000 in dividends. What effect does dividends have on retained earnings? We said dividends cause retained earnings to decrease, so I'm going to subtract that $2,000 as well. Now, if I add these numbers and remembering to subtract the numbers in parentheses, I will get retained earnings on December 31st, 2020 to equal $7,000. So that's retained earnings on December 31st, 2020. I just added all these numbers together. Let's look at the timeline. Now we're here on December 31st, 2020. And we find that retained earnings is $7,000. The very next day, which is January 1st, 2021, if I had $7,000 at the end of the previous day, the beginning of January 1st, 2021 will be $7,000. So that would be our third question. So let's take a look at retained earnings for 2021. We start on January 1st, 2021 with a beginning retained earnings balance of $7,000. They told us that revenues were $20,000. We know revenues has the effect of increasing retained earnings, so I'm going to add that $20,000. Next, they told us expenses were $14,000, and we know that expenses has the effect of decreasing retained earnings, so I'm going to subtract $14,000 from that number. Finally, they told us that there was $5,000 that they paid out in dividends. We know that dividends have the effect of decreasing retained earnings, so I'm going to subtract that $5,000 as well to determine the ending retained earnings for 2021. Now, all I would do is combine these four numbers. Don't forget to subtract the numbers that are in parentheses, and you find that December 31st, 2021, the retained earnings would be $8,000. So if you look at retained earnings of a company at any given point in time, it is the cumulative total of all the profits and losses minus any dividends paid out to shareholders since the company's beginning of time. So to summarize this video, this is your basic accounting equation, but it can be expanded. The stockholders' equity section can be expanded to show common stock and retained earnings as being two components of stockholders' equity. And then under retained earnings, you need to know that revenues, expense, and dividends do affect retained earnings. Revenues have the effect of increasing retained earnings. Expenses and dividends have the effect of decreasing retained earnings. That's it for this video. If you have any questions, please let me know.